There we go. Okay. All right. Chapter 1. This is our book once again. Even if you're sharing it with a classmate in this class, then you got to have the book. And I highly recommend bringing it to class because as I go over problems on the second day, you can follow along in the back, and when you start doing them in groups, you'll be able to do the same. So the uses of accounting information and introduction to the basic set of financial statements, which is what we're going to focus on through the first two midterms, is just financial statements and their preparation. So accounting is a system. It is a system that has been used basically unchanged since the 1200s. There are surviving records from 1300 AD that use debits and credits, ledgers, financial statements in the same fashion that we do today. It is a way of taking business activity and capturing it through data in source documents, process those transactions in a logical format in order to produce financial statements that report to a variety of users what happened, either the last month, the last quarter, or the last year, to an entity. Those reports are then used to influence decisions that create new business activities. All right? So that's the cycle. Around and around on a daily basis, and a monthly basis, and quarterly and annually. For-profit businesses have two overarching goals. There are two things that must exist for a business to survive. They have to be profitable. Whatever it is they do, whether they manufacture, whether they just provide a service, or whether they retail out a product manufactured by someone else, they have to do so to where their costs are less than the revenue being generated, to make a profit, to make net income, to be in the black rather than the red. But equally as important as making a profit, they have to be liquid. Liquidity is producing enough cash to be able to pay your bills when they're due. Most importantly, payroll. Because the day that you have to go in and explain to your employees that there is no money for payday, news I highly recommend giving from afar. Do not show up in person to deliver those news. I've come close, very, very close, twice in my career. Before I started teaching full-time, I was a controller and a chief financial officer, primarily in the aerospace business for 25 years. And twice I came real close to not making payroll. Was able to do so in both cases. But the first time we had 1,100 employees up at the big orange hangars there at the airport. When I was there back in the late 80s, it was called the D. Howard Company. It's now called San Antonio Aerospace. And we almost didn't have enough to pay the 1,100 employees. And the vice president of human resources said, well, we'll just get on the PA and we'll announce it on Friday morning that there won't be payday that day. I went, you can do so, help yourself. I will be elsewhere, hiding under a rock. I'm not coming here if we're not going to have enough money. And then we were able to get some money in on Thursday in order to be able to make that. So they got to have both profitability and liquidity. And we'll talk about this over and over and over again throughout the semester. 3 things that businesses do on a daily basis: operating activities, investing activities, and financing activities. These are also the 3 sections of one of our financial statements, the statement of cash flows, which is also the very last statement that we deal with. If you remember from the course outline, it was the one right before the final exam. Operating activities is what you do on a day in and day out basis. It's what you get up in the morning to do. It's buying inventory. It's incurring utilities. It's having people work for you and earn wages. It's selling your product, your goods, your services. It's everything you do on a daily basis. Investing activities is taking capital, whether it's net income, profits that you've generated, or new money from shareholders or lenders, and buying assets to make money with. Buying new delivery truck, or a new piece of manufacturing equipment, or a new computer system. So your investing is long-term assets that you then use to generate more revenue. And then financing activities is either borrowing money or getting money from the investors. No matter what form of business, 2 ways to generate capital. You can go borrow it, what is known as OPM, other people's money, or you can put your own money in, all right, in the form of either capital stock or partner's capital, or in the case of a sole proprietor, you're investing money into your wholly owned business. All right? So operating, investing, and financing activities. So this is how the 2 work. You've got those 2 overarching goals of profitability and liquidity, and you do so, God bless you, do so with operating, investing, and financing activities. All right? The very last chapter is that there are a series of analysis or ratios that you can calculate that focus on those 3 areas. And they test as to how well a company is doing meeting its 2 overarching goals. How well are they generating profits, and how well are they generating liquidity? All right? We're going to be focusing that. As in your book, you'll see that they introduce these ratios little bits at a time throughout the chapters. I'm not going to focus on it until the very end. I'm going to wait until we build the foundation of knowledge in the first 15 weeks, and then we'll focus on the ratios. Okay? This course is entitled and focuses on financial accounting. Financial accounting follows, as I alluded to at the very beginning of the class today, follows generally accepted accounting principles, GAAP, G-A-A-P. There's all sorts of rules. American GAAP has 35,000 pages of standards, pronouncements, interpretations, industry-specific guidance. The international rules that we promised the world that we were going to adopt has 3,500 pages. They're very general in nature, where U.S. GAAP is very specific. And as we get into the details, you'll see just exactly how specific some of this guidance is. All right? It's a very mature. U.S. GAAP has been around and codified since the 1920s. The international standards started from a blank piece of paper in 2001. So ours is a very old system. Theirs is a relatively new system. Management accounting is what you'll get introduced to in the second principles class next semester. That's managerial accounting. There are no rules. You can do for management reports anything you want. Creative as you want to be, because it is not released to the general public. It is for management. So if you want to do profit on a per item basis, or you want to do how profitable it is on a Thursday, have at it in managerial accounting. All right? Financial accounting is not just for internal users. Internal users are the management and the employees and the owners, the shareholders. Financial accounting is released to the general public. You can go to any publicly traded company in the United States. If it is listed on a public market, the New York Stock Exchange, the NASDAQ, even if it's just a bond, they're selling a security in the form of a debt instrument. If they're producing it, they're required by the Securities and Exchange Commission, the SEC, to produce a set of financial statements and release them to the public. So you can go find all of the financial statement information you want on General Motors and Boeing and Nike and McDonald's and Apple and IBM and all, Dell. Well, used to be. Dell went private. Dell's a bad example. They don't have to produce financial statements anymore. They went private. All right? So this is all from bookkeeping, and that's the system by which we generate these financial statements, following these 35,000 pages of rules. To that end, the reports that we give to investors and creditors on publicly traded companies have to be audited. An independent CPA firm has to come in and examine the books through a series of audit procedures and test the accuracy. Do they present fairly the financial performance of this particular entity? All right? And they sign a statement to that effect. Securities and Exchange Commission is the big regulatory agency that oversees all publicly traded, and the key word there is publicly traded. If you're not selling a security, whether it's a debt instrument or an equity instrument, if you're not selling it on an open market, you do not have to produce audited financial statements. Now, more than likely, your banker is going to require it. If you borrow any money of a substantial nature, then your banker will also require that you have an audited financial statement. Other groups that use information that we produce from financial accounting is labor unions, investors, creditors, economic planners, the general public. You as a potential employee. If nothing else, which I meant to ask this, how many are interested in majoring in accounting in here? A few. The rest of you I refer to as potential accounting majors. It's my job over the next 16 weeks to sell you on the profession. I'll do my best. No pressure. Even if you learn nothing else from this course, obtain enough financial knowledge to be able to determine whether the company you're getting ready to go to work for is going to be there in 6 months to a year. All right? I'm going to teach you enough to be able to look at a financial statement and make an educated decision and avoid going to work for Borders or Blockbuster or one of the many other companies that are gone bankrupt or about to go bankrupt here in the next couple of years. Because if you can read a set of financial statements and they're not complicated, you do need to have some basic understanding of financial accounting in order to read them. But if you can read them, you can avoid those dreadful mistakes. Don't go to work for a company that's on the downslide. Go to work for a company that's on the upside. All right? Because you don't ever want to be there the day that the controller or CFO calls in from an undisclosed location and tells you that you're not getting paid today. Okay? Just avoid that. All right, so these various decision makers, whether they're internal or external, use accounting information in order to make decisions. Whether you're an investor, if you're going to go out and start investing some of your hard-earned money in a retirement fund, be able to make some decisions as to whether or not this is a good investment. Your decisions are very simple. When you own stock in another company, you can either buy more of it, you can hold on to what you have, or you can sell it. It's only 3 options: buy, hold, or sell. And what you learn in this class can assist you greatly in being able to do that. So what are we doing? We're answering 4 simple questions on each and every business transaction that occurs day in and day out, second by second, minute by minute. In the case of a large multinational corporation, 365 days a year. 24 hours a day. What has just happened? Can it be measured? Should it be measured now? Is this a transaction that is affecting something in the future? Perfect example is you issue a purchase order to buy some inventory. It hasn't shipped. You haven't received it. There is no business transaction yet. You hire a new employee. That's a business transaction. You've made a decision, but there's no accounting necessary until that employee actually shows up to work and starts earning some wages. All right? So has something occurred, and is it needs to be recorded now? If it does need to be recorded, what value is that particular transaction? And a lot of it's straightforward. You're paying somebody by the hour or by the month on a salary. You know what the inventory item cost you and how many you bought. Some of it's not so obvious. Some transactions can be highly complex. You go out and you buy a cell phone. You all have one. Did you sign a 2-year contract or not? Because if you did, then the price you paid for that cell phone is less than what it would have been if you had not signed a contract. So how much revenue does ACCT or Verizon or Sprint generate on the sale of the handset? Some of it's deferred, because some of it is built into the monthly fee that they charge you over the next 2 years. Portion of that, whatever it is that you're going to pay per month, is really going towards the purchase of that handset. It's not going towards your monthly service. All right? And then lastly, how should it be classified? We'll talk about the classification here in a second. So a business transaction, as I alluded to, is any kind of an economic event that affects their financial position. Each and every one, earning of wages, the buying of inventory, the selling of goods, products, and services, requires an entry into the accounting system. Every one of them. Okay? We measure it all based upon a unit of currency. We're going to be using US dollars. If I was teaching this class in Hong Kong, we'd be using Hong Kong dollars. If I was teaching it in mainland China, I'd be using renminbi. Whatever currency that the entity is located at, which complicates matters. Because if I'm a U.S. company and I'm doing a business transaction in a foreign currency with somebody from abroad, how do I value that? For that, we need to use exchange rates, which is what is the money, what is a U.S. dollar today when I need to record the transaction worth in the foreign currency. And there's a whole set of websites that'll tell you exactly what's going on as far as exchange rates go. And a lot of this is theory, and it'll make a lot more sense. Every time when I'm introducing things and you start to get what I call the furrowed brow, and I, in addition to asking the question, do you understand, if I occasionally look out on the classroom and all I see is this, then that's the furrowed brow, and I realize I've lost you, and I'll come at it from another direction. But one of the important theories in accounting is the separate entity. We do accounting records for individual entities, whether they're an individual, such as yourself. I mean, you can keep accounting records on yourself. You can record in an accounting set of records everything you expend and everything you buy, and do a balance sheet and produce an income statement and all that. Or is it a corporation? And the key here is that if you don't mix the transactions that affect the shareholders into the corporation's books, because they're separate. All right? So it needs to be distinct from its owners and such. So I don't know what other business courses you've taken so far, but we're going to go over it briefly. There are 3 forms of business worldwide. This isn't just the U.S. You can be a sole proprietor. That's you. You leave here today and decide that you're going to be an accounting tutor. You're going to charge your classmates a couple of dollars for your valuable insights, and you're going to charge on a per-hour basis. Boom. You're a business. Done. You didn't have to register with anybody. You didn't have to go to this Austin and incorporate. You didn't have to draw up any legal documents. Nothing. The only thing that's happened is you've slightly complicated your tax return, because sole proprietors report the revenues and expenses that they do in their individual endeavors on what is known as a Schedule C in your 1040 tax. That's it. Simplest form of business out there. Your tutoring business takes off. You've got so much demand across all 6 sections of principles of accounting that you can't handle all the business yourself. So you approach a classmate who's also doing very, very well in this course. Say, come join me. We'll split the profits 50-50. Maybe 60-40, because it was my idea. Bringing you on after the fact. I built the business up, so you can have 40, I'll take 60. That's a partnership. Once again, can be very informal. Can be a handshake. It can be very formalized. All of the big international accounting firms, most of the law firms, many of the medical practices are partnerships. They have very, very sophisticated articles of partnerships and how does one become a partner, how does one leave a partner, how do you split the revenues and expenses and stuff. But it's just two or more is all it takes. It can be tens of thousands, hundreds of thousands. Just needs two. The third form of business is corporations. Corporations are separate legal entities. They are incorporated in the state in which they file for incorporation. It's not complicated. You take a form, Articles of Incorporation, up to Austin to the Secretary of State for the state of Texas. You file those along with a fee, and assuming you've picked a unique name and your Articles of Incorporation are in order, has all the items that it needs to have, boom, you're a corporation. Corporations are separate entities that have the ability to do everything you as a citizen of the United States can do, with one notable exception. They can be born, they can die, they can get married. You can take two corporations and combine them together and make one. They can be divorced. You can take one corporation and turn it into two. They can own property. They can enter into legal contracts. They can sue. They can be sued. They can do everything that you as an individual can do, with one notable exception. Any guesses? What can you do as a U.S. citizen that a corporation cannot? You can't, corporations can't vote. That's it. Everything else they can do. All right? It is the least number of businesses, because it is a little bit of a complex situation to go up and get incorporated. Sole proprietor is overwhelming. I mean, everybody can. These are very easy to do. So your landscaper, your maid, your plumber, more than likely are all proprietors. But corporations generate the largest number of revenue. And the notable reason for that is corporations have as an advantage that partnerships and sole proprietors do not, limited liability. And when you get to business law, they'll talk about that a little bit more. But limited liability, the shareholders are only at risk in a corporation equal to the amount that they put into the business. So in other words, I go out and buy Boeing stock. If Boeing goes away, the absolute most I will ever lose is the amount that I put into Boeing when I bought the stock. All right? No one from outside Boeing can come and take my house or my car or my savings or retirement or garnish my wages. The same with a closely held corporation. If you go incorporate your landscaping business and you put a couple of $100 into it in order to buy some lawnmowers and weed whackers and a trailer and stuff like that, and then you're out there mowing the lawn of one of your customers and you accidentally cut down her prized rose bushes and she sues you for everything you have, all you can lose is what you put into the landscaping business. Everything else is safe. So limited liability is the reason the vast majority of commerce is generated by corporations. All right? And almost everything that you know, McDonald's, Nike, all of it, they're all incorporated. Okay? All right. So here's the real meat of this, and then we've got 20 minutes. We'll get through it. The financial statements. There are 4 basic financial statements that we're introducing in Chapter 1. And we will be focusing on 3 of these 4 all the way through the second midterm. That's all we're going to talk about and do, are these 3 financial statements. The first one is the income statement. The income statement is where we report all the revenues being generated, subtract out all the expenses that are being incurred, and we calculate net income, the profitability, one of the 2 overarching goals of every for-profit entity. All right? The income statement measures activity. It is for a period of time. You can produce an income statement for the week ending, for the day ending for that matter. Most often it's for the month ending or the quarter ending or the year ending. So it measures activity that has occurred throughout that period of time. This is an example. Revenues from consulting fees, $10,000. They rented some equipment. They paid some wages. They incurred some utilities. They had income before taxes of $4,400 after deducting these expenses. They paid some income taxes on that income, and net income was $3,200. All right? The second one is the statement of retained earnings. Retained earnings are profits that are left in the business. Because if you make a profit, there's one of 2 things you can do with it. You can either distribute the profits to the owners. So if you own a corporation and you've made some money at the end of the month, you can take that money out of the corporation. It's a dividend. All right? Boeing and all the rest of them pay dividends. It's a distribution of profits to the shareholders. What's left is retained earnings, and it accumulates over time. All right? That also is a statement that measures activity. It starts with net income. Well, it starts with the beginning balance of retained earnings, the retained earnings from the last period. Add in the current year's profits, net income. Subtract out the dividends, and that gives you the ending retained earnings. So this was the first month of operation, this month of December. They had 0 retained earnings coming in. We saw from the income statement that was just up there, $3,200 was the net income. They then distributed $2,400 to the shareholders of this corporation, and that left them at the end of the month $800 in retained earnings. The second of the 3 financial statements that we'll focus on. The third one is the balance sheet. The balance sheet is a representation of the accounting equation. Assets equals liabilities plus stockholders' equity. Everyone has an accounting equation. Assets are everything you own. In the case of a business, everything a business needs in order to conduct their operations. It's all their cash, their accounts receivables, their short-term investments, their inventory, their property, plant, and equipment, all their delivery trucks, their buildings, their warehouses, their stores, everything they own in order to conduct their business. The other side of the equation is how did they pay for it? Now you know that, right? As college students. You go to H-E-B. You want to buy something. 2 ways of paying for it. Cash or credit. Comes down to that. It's as simple as that. You can either use your money or other people's money. Other people's monies are liabilities. This is the stuff that you borrow, either from a bank or from a vendor in the form of accounts payable, or from your employees if it's wages they've earned but you haven't paid them yet. Liabilities. Stockholders' equity is either all the money that the owners put into the business combined with the money that they left in the business. So it's all the common stock plus the retained earnings. It's stockholders' equity is all of the money that the owners have put into the business or have left in the business. So a component of stockholders' equity is from that last statement, the statement of retained earnings. Retained earnings. So the owners have decided, out of that $3,200 that this mythical consulting company made, they decided to only take $2,400 of it. They left $800 in there. That's as good as contributing it. It's part of their money. That's this portion. Okay? All of this is displayed on the third statement called the balance sheet. The balance sheet is unique in that it does not measure activity. It can't. It's all of the assets, liabilities, and stockholders' equity at a moment in time. The stroke of midnight on the last day of the financial period. So on December 31st for a calendar year corporation, at the stroke of midnight, how much cash, how much inventory, how much debt, how much retained earnings, how much stockholders' equity did they have at that moment? And for that reason, when we get to on Wednesday, you'll see we entitle it, we date this financial statement slightly different than we do the income statement or the statement of retained earnings. Because they measure activity, this does not. It's just a picture in time. Okay? All right. And you'll see here. This says for the month ended, as did the income statement, for the month ended, whereas the balance sheet is just December 31st. It's not measuring activity. It is not for the month or for the year ending. It's just December 31st. And that's a key difference. All right? And then the last one is the statement of cash flows. I'm just going to introduce it. We'll in depth when we get to chapter 12 at the last weeks of the semester. So this is all the inflows and outflows. This is reconciling the cash balance. How much cash did we start with? And what did we end with? And where did it come from? Or what did we use it for? All right? So you start with net income. You make some adjustments. Here's your operating activities. This is everything you did on a day-to-day basis. Here's what you invested it in. You bought some land. You bought some building. Here's where it came from. You sold some new stock, paid some dividends. If you borrowed some money, that would be in here. If you paid back some money, that would be in here. Started the cash at the beginning of the month with zero. You generated $61,200 during the month of December, and that's what you had at the end of the month, was $61,200. But we'll focus on this statement much, much later. Starting Wednesday, we're going to be dealing with the income statement, the statement of retained earnings, and the balance sheet, and how they all fit together. Because remember, our income statement was $3,200. That flowed to the statement of retained earnings. to give us an ending balance in retained earnings, which is a component of stockholders' equity. Because as I said, it's either the money the stockholders put in or the money they left in the business. So they're all tied together. All right? Gap we talked about. Talked about this. Not even going to worry about that. Not going to worry about that. That's it. All right? Quiz Wednesday. And almost if there's not a midterm, there'll be a quiz every day.